Good afternoon, everyone, and welcome to Dubai Expo 2020 right here at the Malaysian Pavilion building in Dubai. My name is Ben Ibrahim, and it's a pleasure to be your Master of Ceremonies and moderator for this week. And very, very shortly, we will have a panel session titled Venture Debt in Southeast Asia, Present Landscape Challenges and Opportunities. This session will be moderated by Mr. Farid Rosli, Senior Vice President of the Venture Finance Division of Malaysia Debt Ventures Berhad. He is primarily responsible for the sourcing, evaluating, and executing the credit application under the use of venture finance, or the venture finance mandate, shall I say. And Cheah Farid has over 20 years of exposure and experience in private equity and venture capital investments in both the Arabian Gulf and the Southeast Asian regions. So obviously from his CV, we are in very, very good hands. It's a very interesting topic. For those of you who are watching us through various social media channels, please feel free to leave some questions, your opinions and comments, and we will try to get to it and address those points as we go along. Don't forget, all of you are part of Dubai Expo 2020 right here at the Pavilion building, the Malaysian Pavilion building in Dubai. So without further ado, over to you, Encik Farid.
Hello and welcome everyone. I hope everyone is in good health and enjoying the Expo so far. Today is a very special day because we are about to hear from 4 experts panelists, expert in their respective fields, whom we brought in especially from Southeast Asia region. We are going to talk and discuss on the very interesting topics, and I'm sure many of you, our dearest entrepreneurs and business owners who are here today would be agreeable with me. The topic in general we will touch upon today is fundraising, in particular of quite a unique product, which is venture debt. So our expert panelists will share their views on venture debt in Southeast Asia, present landscape, challenges, and also opportunities. For the benefit of our viewers, venture debt is not similar to venture capital investment. However, usually it is structured alongside venture capital equity product. Okay, I will let our panelists to explain about venture debt in more details later on. For an outline on how this session is going to be conducted, we will divide the session into 4 rounds, and each round questions will be asked based on the following subjects. Number 1, Southeast Asia startup ecosystem, the overview and growth opportunities, venture debt as a source of funding, startup funding and fundamentals, and lastly, we will cover on talent and challenges. Okay, before we dwell into our topic further, I would like to make an introduction on our distinguished panelists. We will allow our panelists to introduce themselves, nonetheless, to tell us which organization they are attached to, and in general, what do they do in particular in this organization. Okay, let me invite Patrick. Please introduce yourself, Patrick.
Thanks, Farid. Hi guys, I'm Patrick Yo from PwC Singapore. I run what we call the PwC Venture Hub. So it's an outfit that we work very closely with the startup ecosystem as well as investors looking for tech deals. We also build our own portfolio. We look at Southeast Asian companies. We look at Southeast Asian investors, right, looking for tech deals, and we work a lot across the globe as well, bringing in the technology companies into Southeast Asia. So that's what we do.
Okay, thank you very much, Patrick. Next panelist, let us welcome Taufiq. Appreciate you could do a quick introduction about yourself.
Right, thank you, Farid. My name is Taufiq Iskandar. I'm the Chief Investment Officer of Penjana Capital. Penjana Capital was incorporated on the 1st July of 2020 as part of the Government of Malaysia's initiative to accelerate the development of a future innovation economy. And Penjana Capital's main role is to administer and deploy Dana Penjana National Program, which is a matching fund-on-funds program where the Government of Malaysia will match on a one-to-one basis of the capital raised by the VC fund managers, either from foreign or local private investors. Over to you, Farid.
Thank you, Taufiq. Our next panelist, Cheam. Can you make an introduction of yourself?
Sure. Hi everyone. Morning. My name is Cheam. I'm with the Institute for Capital Market Research Malaysia. ICMR was established back in 2018. We are an independent think tank dedicated to conduct research for the capital market, mainly on structural issues and then for new developments, etc. So my portfolio, I looked into fundraising and also alternative asset classes in this part of the world. So nice meeting all of you.
Thank you, Cheah. And last but not least, our Ben. Please make an introduction about yourself, Ben.
Thanks. I'm Ben. I'm from Innova Capital, Southeast Asia. I run the Southeast Asia operations. We are a venture lender. So we're doing venture debt since 2015-16, and we lend across a variety of industries and investors, trying to bring this newer instrument to the ecosystem. So Innova Capital is a Pan-Asian venture lender that has offices in India, China, and Southeast Asia. So from Southeast Asia is based in Singapore, and we cover that. I personally have been in Innova Capital since 2016 when it started in Southeast Asia. One of the first few team members in Southeast Asia to try and start this year. Prior to that, I had a couple of years experience working in commercial banks in various roles, mainly client coverage and variety of industry coverages. Yeah. So happy to be on this panel. Thanks.
Okay, thank you, Ben. Okay, great. Thank you to all our panelists for making the introduction short and sweet. Before we proceed with the discussion topic, we'd like to share with the audience a study done by PwC Singapore on venture debt in Southeast Asia. This comprehensive study will tell us on how venture debt plays an alternative funding for startups and early stage companies. Let us invite Patrick to share the studies and take us through his presentation.
Hi guys, very good morning or good afternoon from wherever you are. Thanks for joining us in this virtual session. The topic I want to touch on today is really talking about the venture debt in Southeast Asia. So this was a report that we issued sometime in May 2021. So we looked at the venture debt, what it means, what is the overview, and what is the trend that we have seen, and we kind of forecast what's going to happen going forward. If you just look at this particular slide, just as an overview, right? Venture debt model kind of originated in Silicon Valley in the 1970s. And the likes of very big tech companies like Google, Facebook, Airbnb, Dropbox, at some point during their life cycle, they have taken on venture debt. And it's already very established kind of financing source in US, Europe, Israel, and India. And it's coming to Southeast Asia, right? When we did this report together with Genesis in May 2021, we tried to find data in Southeast Asia, but obviously it's still in the infancy stage. There is limited data. However, right, through the multiple sources, we kind of can triangulate the data, and we estimated, right, Southeast Asia venture debt penetration is between, I would say, 2 to 4% currently. And if you look at the funding cycle, you look at the funding growth, both from an equity and venture perspective, we are expecting the growth to be up to 5 to 10% of total venture fund going forward. Now, why do we say that venture debt essentially is the new growth mantra? There's always a perennial kind of discussion between debt versus equity, right? We've got to recognize that venture debt is an alternative source of capital, right? It is good, it is important. Why? Because it limits dilution, right, to the startup founders. And typically startup founders being owners of the business, they do not like to give up control, right? Hence, that means they do not like to give out too much equity, right, depending on the valuation. So at the end of the day, throughout the life cycle of the company, of the startup, it is very important for them to achieve the optimal funding structure. And venture debt is going to be one critical component of that. And when that is achieved, it clearly will enhance all stakeholders' value, right? Not just for the founders, but for the management, people with ESOP, as well as the equity and debt, other debt holders. Now, the next point I want to touch on is really on the characteristics of a startup founder. As we know, right, startups always want to go through the hockey stick growth. They're targeting that, right? So at the inflection point, that's about when they should be looking at venture debt. And what are some of the characteristics? They are likely not profitable yet, but that does not mean that they can't go for venture debt. Because at the end of the day, venture debt is looking for companies with steady cash flow so that they can return some of the principal and interest. And a lot of these companies, they potentially will lack the prerequisite financials and the business track record. Hence, they can't go to the traditional banks for financing. And as I've said earlier, right, they tend to be at the growth stage. And at the growth stage, the founders will want to minimize equity dilution. And that is a very important consideration. The other point is really to extend the cash runway, especially during this pandemic period when the cash buffer is running low. It helps to increase the valuation without the dilution, and it gives the founders, the various stakeholders, a longer runway. And last but not least, it's really to build up a good credit history, right? And this will go a long way to help them to improve and to increase their future funding rounds. Now, if you're one of the startups looking for venture debt, right, what should you consider, right? So you should, like the picture here, right? You open up and you put in the pros and cons between debt financing versus equity financing. So very importantly, you've got to understand what it means, if you're going for venture debt. What are the pros? What are the cons? Right? Write it down. Discuss with your other founders, with your other stakeholders. And discipline is very important because venture debt means that you need, right, more often than not, a regular repayment schedule. And that would mean you need to have some kind of a steady cash flow. And because of that, discipline with regards to financial budgeting will become critical. Last but not least, different venture debt providers obviously will have different kind of terms, notwithstanding the fact that the general terms are pretty generic, right? So you've got to understand the terms in your agreement, right? Speak to your lawyers, speak to your other stakeholders, understand the terms, and negotiate for your best possible deal. Now, I just want to end off by showing you guys, the QR link to the report, and happy, to take the discussion further during the panel discussion. Thank you very much.
Thank you, Patrick. It is a very insightful and informative presentation. I'm quite amazed, actually, despite the venture debt has been around since 1970, started in Silicon Valley. Southeast Asia region is kind of a late starter or adopter, and the penetration of venture debt product is only about 2 to 4%. This actually shows a huge potential for venture debt to grow in Southeast Asia region in particular. So this is a good start actually to kick off our first round of the session. Thank you again, Patrick. We will start this session with a general question to all panelists. As we look back in the last 5 years also of the startup investing landscape, what do you think that are the most important changes or developments that have taken place in terms of our investment trends? Do we see any similar trend in Southeast Asia? From Innoven, what is your view on this, Ben, please?
So new investment trends, right? I have to say it's quite a roller coaster because pre-COVID there was one set of trends, and post-COVID we have a second set of trends. So I think I'll highlight two major trends that we're seeing now. One trend is a resurgence of investments into sort of e-commerce. Let's call it e-commerce 3.0, right? No more general e-commerce, but all that. I mean, and of course, deliveries and anything that minimizes offline contact. This is of course driven by COVID lockdowns and things like that. So in this kind of climate, anything that prevents offline contact, but substitutes offline contact with online starts to do well. Obviously, lowest hanging fruit will be grocery delivery, online education, and a new wave of e-commerce shops. And then born out of that will be ancillary things like the people powering all this, like the logistics 3PL, fintech guys in the payment space, and of course the much talked about Thrasio model, where they start to consolidate e-commerce brands, driven by a shift in consumer focus to acquire, to spend a lot more online basically. So whereas corporations and of course enablers, whereas corporations and sellers used to depend a lot on offline, now it's commonplace, everybody must go online, and then that breeds what I call like another wave of e-commerce 3.0. A bit related to that, the second trend that we see would be fintech and banking services. Because people go online, one of the major things that go online as well is banking, right? And so whereas the incumbent banks, the larger incumbent banks have a large offline network, they find they are slower to innovate, and so we see the emergence of new banking sort of players now trying to do a 100% online experience and going deeper into these functions, right? Not just a wallet, but a full banking account. In some cases, they may compete with the incumbent banks, but in some cases, they may collaborate. So these are interesting trends. A lot of these companies, we know last time they provide services like I would say just specialist services like just payments or just lending. But increasingly, we see them converge into trying to be full digital neobanks. As I said, sometimes in collaboration with the incumbent traditional bank, and sometimes in competition. So these two, for this year at least, will be what I can see are emerging trends.
So it seems consumer behavior is driving development in tech startup. Similarly, the investment trend too, right? So thanks, Ben, for the insightful views. Same question I would like to ask Taufiq from Penjana Capital. What is your view on the same subject? I would like you to also link this with Penjana Capital initiative to boost startup fundings, especially in Malaysia. Recently, Penjana Capital launched a 600 million fund and seeking the fund to be matched with other LPs. Please, Taufiq, what is your view on this subject?
Thank you, Farid. I would like to add to what Ben has said about the primary forces behind rapid growth in innovation, as well as the development of startup scenes in Southeast Asia, if not Malaysia. Apart from the consumer behavioral shift that we've seen in the region, as well as technology-enabled innovation in some of the provisions of key services, like what Ben mentioned, fintech, among others, I think it is very important to also highlight another primary force behind this innovation, and that is the availability of liquidity in the market. There's so much savings sloshing around, looking for an asset class to house this liquidity. And we have seen a very benign interest rate environment and a lower cost of capital. So that means more and more sophisticated investors, institutional investors, as well as money managers are climbing up the risk ladder. And this benefits venture capital as well as venture debt asset classes. And the reason of these so-called move towards a slightly higher risk asset is because of the prevailing low yield environment following governments and central banks intervention. And this made innovation possible. Lower cost of capital funds technology-enabled innovations and also allow startups to undertake a longer investment strategy and product development. So I think this is one of the primary force behind rapid rise in innovation, as well as the growth of the startup scenes in Malaysia, if not Southeast Asia. And Penjana Capital has a part to play. Penjana Capital role is to strengthen the intermediaries, and that means building up the VC ecosystem, by having a vibrant VC ecosystem. And vibrancy here refers not only increased participation of a private VC fund managers, but also in terms of the development of the size of the VC funds. We will support the development of the startup scenes, which is the end beneficiary of those capital. And just to put things in perspective, Farid, Asia, within Asia, Southeast Asia only represent about 10% of the venture capital available. And the large chunk of the venture capital are actually, moved to China, representing about 60% of the venture capital size. And India represents about 11 to 14%. So Southeast Asia only 10%, and Singapore dominates about 40% of that. So there's still room for growth, particularly for countries such as Indonesia and Malaysia. Indonesia has 270 million populations, and the venture capital scene actually doubled almost every year beginning 2016. Just bear in mind, in 2012, venture capital scene is almost non-existent. Similarly, for Malaysia, we have seen some stagnant in terms of new VC commitment. That's because our dependency on the government-backed investors. Government-backed agencies such as MEFCAP, even Malaysia Debt Ventures, represent about 42% of the committed capital. So we need to increase diversity of participants in the ecosystem, and that will lead to more vibrancy for the VC ecosystem. That's all, Farid. Over to you.
Very interesting view, Taufiq. Thank you very much. Your key point here is basically low interest yield drive fund managers or money managers to allocate capital to a higher risk segment. It is actually an eye-opening. Actually, let us have another point of view from Cheah. What is from your perspective, looking from capital market point of view? Do you see a shift in capital allocation towards startup and early stage companies with the development that were mentioned, by our earlier panelists?
I think before I begin, I like to echo some of the points raised by Ben himself. I think what drives innovation recently is, in addition to the fintech phenomena and also people turning to online for their businesses, I think the other thing that could possibly drive innovation is also because of sustainability purposes, or ESG itself, because it's a big after COVID-19 has shown us that the importance of sustainable investments for the investing world. So hence, I think, for example, if you look at how Singapore recently, some of the initiatives that were undertaken by Singapore, the COVID-19 pandemic, right, has caused border closure and etc. for all the countries. And then for a nation that have 90% of their food dependent on import from other countries, hence they have taken initiatives to actually look into broaden the food production in Singapore itself, hence the 30 by 30 challenge and etc. So what startup itself should actually look into how to, especially in the agricultural sector, should look into how innovations and new tech could help them to increase production and to avoid another rounds of lockdown and then border controls and etc. To increase food production and all. So these are some of the trends that we observe stemming from the COVID-19 itself, and also some of the sustainable thematic that we have observed. Now, having said that, what you asked earlier, that whether these investments have moved down to the smaller startup scales, the answer is yes. We have seen some bigger funds now are actually taking an earlier investments in early stage companies. They have instead of taking their usual role in the growth stage, they have started to venture into early stage startups to actually look into more alternative or investment alternative for themselves. As valuations in Series A continue to soar, early stage investing represents a uniquely lucrative opportunity for these funds. Big players are expanding their early stage and seed investment portfolios, changing the funding landscape for startups and new founders alike. These larger funds are devoting more institutional resources to identify and cultivate early stage investment through such discovery funds and accelerator programs, and are actually working side by side with LPs and funders to actually spur creative technological and business solutions to them. So yes, we have seen bigger funds, more funds are actually working downstreams, but the thing is that they are, instead of doing smaller ticket size investments with lots of deals, we have seen that they have actually made bigger size ticket offer. They are actually offering larger ticket size to fewer deals.
Interesting. Thanks, Cheah. Apparently, innovation and sustainability is key in the shift of capital. Yeah, I think that's basically a strong movement there. Now we're gonna move to Patrick. Patrick, your active engagement with SMEs in particular surely give you a good insight for this next question. According to the International Trade Center, COVID-19 has impacted, or rather, International Trade Center COVID-19 Business Impact Survey has found that 55% of 4,500 respondents from 132 countries, they are strongly affected by the pandemic. About 2/3 of the SMEs operation are severely impacted, with 1/5 of them are at risk of permanently shutting down. This is actually quite a glaring numbers. Can you share with us how technology company can stay afloat and sustainable amidst this pandemic?
Thanks, Farid. I think I'll split this into two parts. One is preparation pre-pandemic, right? And one is when the pandemic strike, what the startups or what the tech companies can do, right? I think the biggest issue for tech company is the failure to plan properly, the failure to do financial budgeting. A lot of times when we go out to the market, we work with the tech companies and they come to us for support with regards to fundraising. The issue there is always, what is the runway that you have? If the runway is too short, then it's going to be very challenging, right, to raise money in a very short period of time, notwithstanding the fact that the product or the technology is very good. So hence, I would say that pandemic or not, right, it is very important for the tech companies to plan in advance with regards to the financial commitments, how they want to expand, because all this will take up financial resources. And what this means is that it's a natural evolution or attrition where the pandemic simply weeds out, right, the weaker tech companies that didn't plan properly. So it is critical, right, that as a co-founder or as a founder of the tech business, it's fundraising essentially is a full-time job, right? You've got to plan way in advance. You have the sufficient runway, engage your stakeholders, and that's how you can take advantage and opportunities during this pandemic.
Thanks, Patrick. Basically, key here is basically planning, financial budgeting, regardless whether there is a pandemic or not. These are the keys to ensure sustainability of the business. I think that's quite insightful. Okay, let us move to the next questions. This question I'd like to ask Taufiq to give his viewpoint, since Penjana Capital recently concluded its 600 million venture funding matching program. Southeast Asia, home to more than 10 emerging markets, has been attracting large sum of venture capital from all over the world. Startups in this region amass 7.6 billion, where non-unicorn manage some 2.5 billion, raised from investor just in the first 6 months of 2019. This is according to the Economy Southeast Asia report. Venture debt has also been experiencing encouraging growth, particularly at the peak of COVID-19 crisis. In your view, what is the push factors that have led to this development?
Right, Farid. Perhaps to be concise, I would call it 3 P's factor, namely pandemic, politics, and policies. COVID-19 pandemic and politics have accelerated digital transformation in how businesses operate, how supply chains interact, how products and services are marketed as well as delivered, and how consumers behave. In terms of policies, governments push for investment, especially on digital infrastructure, and domestic demand provide conducive environment for startups. Accommodative monetary policies by the central banks mean that financial markets are awash with liquidity. Prevailing low yield environment also forces investors to look for higher yield assets and investment opportunities. And in my view, as institutional investors and money managers chase for higher yielding investments and climb the risk ladder, more and more pool money will be attracted to venture debt and venture capital asset classes, especially late-stage VC investments. And this explains why financing deal pipelines are mostly dominated by unicorns and decacorns, and the successful rounds, like Cheah mentioned earlier, lead to an increase in median deal size of late-stage investments. This is because we have an entry of a new participants in the investment ecosystem, i.e. large institutional investors and money managers.
Okay, Taufiq, thanks. Generally, the low yielding environment pushing investors looking for high return portfolios where they can find in funds that invest in high yielding investment, such as high growth tech startup. That's makes sense. Thanks, Taufiq. Despite economic uncertainty and volatile market, the COVID-19 pandemic has led to a surge in startups. We have seen more businesses are being launched than at any point of time in the past decade. Existing startups are showing a rapid acceleration. As an example, a change in consumer spending habits due to the pandemic has opened up opportunities for consumer-focused startups to compete against more effective and bigger tech companies. Is this something that you are also seeing in Southeast Asia, in which startups are competing healthily against the industry incumbent? And how do you view this change in the landscape for the tech companies post-pandemic? Ben, if you don't mind to give your view in this on these methods.
So my perspective is really new innovations that you have never seen before. The rate of these things coming to the market is about the same, pre and post. But post-pandemic, the greatest thing that's changed is the focus, right? The focus and the adoption of the things, the new things, is the what's accelerated. For example, online e-commerce, grocery delivery, enablers, APIs, logistics, they have been there for like pre-pandemic. But if you look at a cross-section of the companies we look at, and looking at the cohort information, traction information, pre and post, it's very different. Post, the traction is just going up exponentially and organically, meaning the companies don't have to actually go out there and fight for the traction so much. It just comes because people need to go online. So this is going to lead to a new wave of companies that I would say adopt the existing business models to capitalize on this. I expect that new developments, like new ways of doing logistics, or that will evolve. But I think the rate of this evolution is probably going to be the same pre-pandemic. But the adoption of these will be much faster. And perhaps the other thing that will drive new adoption has been the redundancy of old businesses. It's going to, for example, the shopping malls and cinema are going to be quite a good example, right? I think across all Southeast Asia, because of continued lockdowns, and I think across the world, shopping mall foot traffic is just down, right? And so therefore, there will be emergence of more kind of businesses to help people go online, and the shopping mall guys have to do it, or else their business will completely die out. So in this respect, probably you would drive something new. But I think no denying, in the short term, the main push will be the adoption of the new economy rather than the real emergence of new stuff.
I have to concur with Ben, where the main push for change is where access to internet has picked up over the last 5 years, and pandemic leading to continuous lockdown, somehow forcing business to adopt and the new way of doing things in order to avoid being left behind. Thanks, Ben. Okay, we have heard quite an extensive view from our panelists in area of new economic growth and how pandemic changed consumer behavior, and ultimately making businesses more adaptive to stay competitive and be more sustainable. Of course, technology had and continue to enable business to grow. Okay, let's move on to our second round of the session. In this session, our discussion will focus more on venture debt as one option for source of capital, especially for the early stage or startup companies. I would like to ask Ben for this first question, since he is part of an organization that provide venture debt product. Ben, let us talk about the misconception on what venture debt is. There are some diverse perspectives. Some such as will say that this is actually a senior term debt, secured senior term debt, mezzanine subordinate debt, operating line, etc., etc. Right? As one of the largest venture debt providers in Southeast Asia, can you share your perspective and give us a quick lowdown for the benefit of our audience?
I think there are a few things to tackle here. One is the benefit of venture debt. And I think Patrick's report have highlighted it quite well. The number one benefit is the controlling of equity dilution. Allow the existing shareholders and the founders to sort of save their equity and not raise so much equity. More on this topic is it a direct substitute for equity? I have to say it is not, because a debt has to be repaid over a shorter time, a fixed repayment, if you will. For an equity investment, the repayment is not so fixed. They become shareholders, and in return, they get the equity returns, and the debt provider get the debt returns. So this we see a lot. So it is like, is this venture capital? Is it a secured debt? Is it really a debt? How do we look at it? Is this mezzanine debt? So just a perspective, we have been called all that as we talk about it. And then, so is it true or is it not? Well, the question is difficult. Is venture debt secured term loan? Yes, most of the time it is. Senior debt, is it really a debt? Yes. Is it really a mezzanine? Is it mezz debt? We get compared to that because a mezz debt structure look a lot like the venture debt structure, where a mezz debt structure usually has a loan component that may be senior or junior, and has an equity kicker. But venture debt is a senior loan with a warrant component, which is also an equity kicker. So does it look like mezz debt? But yeah, it definitely does. And you're completely wrong to call venture debt like mezz debt. It's an argument that's up for debate. Are we venture capital? We've been called that because venture debt is mainly looking to lend to the universe of companies that VC invest in. So are you a form of venture capital? That's also up for debate. But I think the best way I might explain this is venture debt, guys. We provide debt to the venture capital industry, and we provide the leverage to the companies raising venture capital monies. Are we venture capital, mezz debt? Are we secured debt? Maybe all of the above, depending on it. But I would say that it is definitely a debt, and it is usually secured. It usually does come with a sort of equity kicker to it. But mainly the distinction between us and all these traditional mass debt and all that is we target the venture funded startup, and we sort of provide the leverage there. And it is early access to debt and leverage, if you will, before the traditional bank comes in. So that's how I would look at it. But it is always up for debate, because we overlap with so many areas of finance, and we look like so many different things.
Okay, I can sum up that the venture debt is a debt product, except he has a warrant where lenders can monetize sometime in the future. And this is actually a very interesting feature. Although, the shareholding through warrant conversion is quite marginal, something like 1% or maybe less. But if the borrower gets, a 1 or 2 billion valuation in the future, still it may translate it into a good return to the lenders, right, Ben?
So, firstly, I think the distinction between mass and venture debt is not really the warrant. I think both will take the warrant. Will take warrant or equity kicker. Actually, I think the distinction is in the target segment and the stage of company that we do. Right. So, of course, mass is typically finding a more mature company, pre-IPO, things like that. Venture debt are more Series A type of company. How do you structure the warrant and interest rate? Well, it's like this. The venture debt fund has a target return, like all funds, like VC funds and all that. The return can be made up totally of interest, or can be made up of an equity element. Now, if you're lending to a universe of startups that are burning cash, the interest that you can charge them should be kept to a certain level. Like let's not go crazy, 20-30% interest. No, can't really do that. You have to be friendly because it's like cash burning. So you probably fix an interest rate at a nominal amount, almost equivalent to the highest interest rate that an SME might get from a bank. And then you need to make up the return elsewhere, and that's where the warrant or the equity kicker comes in. So we at least typically structure the loan amount as a normal loan amortizing over maybe 2 to 3 years, and then the warrant amount as a percentage of the loan amount, and we kind of pre-agree the strike price and kind of negotiate the tenor. On a portfolio basis, the venture debt lender hopes that some of these warrants will hit and generate the return required to make up the entire fund's return. In effect, we hope some of the warrants are the next Facebook and next WhatsApp and the next Grab.
Okay, just to add a bit more on venture debt structure, especially the warrant, we also know that entrepreneurs can approach their existing equity investors or request to consider raising, convertible notes. How is this structure different from raising fund via venture debt?
Well, okay. Well, the difference is in the name, I would say. One can convert into equity, and oftentimes do convert into equity, and the other one does not. And so that really is the main difference. The convertible debt should be what I consider an equity investment. It's just an equity investment where the investor, for some reason or another, does not want to put a value on the company yet. It will put a value on the company later on and then convert it into shares. So for all intent and purposes, I do tell people that the convertible debt is really an equity investment. It's just debt waiting to become equity. Venture debt is straight debt. It never converts. So the repayment has to happen as the pre-agreed structure. So that is the key difference. And so of course there are other considerations to this, because stemming from that, then there's the use cases of both. They're slightly different. Convertible debt is used as almost a bridge sometimes, or any sort of situation where the investor doesn't want to value it. A lot of times, if it's internal, the investor may choose not to put a value because in internal valuation may not hold that much credibility. Maybe an external valuation is better. So, but I still want to invest. So convertible. Whereas the venture debt is really looking at a debt that should be repaid. So the company got to, as Patrick's report would mention, do the budgeting. I would say find the appropriate use case for it and sort of figure out where the repayment can come from or how it works and what the value brings. So in some instances, the two work together, right? Some convertible debt goes in to extend the runway. This is leveraged by a little bit of venture debt. So that's kind of, without going into too much detail, that's the main differences.
Thanks, Ben. Okay, very insightful. Okay, we know that to a certain extent, many founders, entrepreneurs view debt from a rather negative viewpoint. They consider layering debt into balance sheet and into capital structure and having to service a debt obligation, despite the fact that the venture debt repayment will likely be interest only for the first few years and something that is quite daunting and worrisome. Patrick, in your capacity offering consultation and advice to companies and entrepreneurs, how would you approach this issue and what would be your advice? In the case of entrepreneurs that brought debt into their balance sheet, what had their experience largely been like, and how did they overcome these fears?
Thanks, Farid. I would advise based on, I would say, 3 factors, right? One is the entrepreneur themselves must understand that the cost of equity, right, generally is higher than the cost of debt. Okay, generally, yeah. And what this means is the element of dilution. Is it important, right, to the entrepreneur, right? Can they get the kind of equity funding? Can they get even debt funding from the bank? So that's something they need to look at. Then number 2, they need to look at their cash flow, right? I think Ben brought up saying that, cash flow can come from 2 parts, right? One is obviously your regular business, revenue generation. The other one is you do a further round of fundraising, right? So sometimes venture debt is being repaid, right, by revenue generation, and also repaid by the next round of fundraising. That is another criteria. The third angle to look at will really boils down to the stage of the life cycle, right, where the tech company is at currently. So if you can't get a bank financing, that's because you're early stage, no credit history, no track record, you're still burning cash, with no profitability. Venture debt could be one good way for you to build the kind of a credit history, as well as use it, right, to extend your runway such that you continue on that hockey stick growth to increase your eventual valuation, where you can raise a bigger round, right, at a lower dilution. So this 3 angles, when you look at it, and the entrepreneurs got to decide for themselves which one is. Do they fit the criteria, right? Do they have steady cash flow to repay the debt, right? As with all venture debt providers, they expect scheduled repayments. So how do you do that? Do you have the cash flow, right? So what stage of life cycle are you at? These are some of the criteria they've got to think about.
Okay, I can sum up that, managing and understanding cash flow is key factors before considering that. Of course, interest and, principal repayment is one of the key factors. So cash flow management is very important here. Okay, let's move on. Of late, venture debt is becoming more mainstream as one of the startup source of funding. For example, Singapore government in 2015 launched a $500 million venture debt program. And in Malaysia, MDV, or Malaysian Debt Ventures, spearheads the industry, where the venture debt offering was introduced back in 2017. We see government plays an important role here in the startup funding ecosystem. Most recently, Penjana Capital introduced a matching fund focusing on startup, a 600 million ringgit fund. Taufiq, based on your observation, how do you think venture debt is currently faring in Malaysia? What is your perspective of the venture debt landscape in Malaysia in comparison to our Southeast Asian neighbor, Singapore, for example? and how we can attain similar growth trajectory and momentum as other more successful venture debt market in the region.
Farid, let me clarify a few things. Firstly, Penjana Capital is an investment house and it acts like an LP. Its first program is Dana Penjana National Program, which is a matching fund on fund structure. So we've selected 8 VC fund managers, and 2 of them are actually venture debt funds. In terms of allocation, the government has committed to match up to 600 million ringgit. That means we intend to raise 1.2 billion in total for Dana Penjana National Fund through these 8 VC fund managers. So far, as of last week, we have raised a commitment of 903 million. So we are on track to reach 1.2 billion in the next few months, despite challenging operating and market environment. Like I said, in terms of allocation of that target 1.2 billion, 16.7% has been earmarked for venture debt asset class. The remaining is actually venture capital equity asset class. And within that equity investment, about 41.7% for late stage investment and the remaining 41.6% for early stage and seed investment. So it's quite well balanced in terms of asset allocation. And the government, as well as Penjana Capital, believe that there is room for venture debt as a viable investment instrument for sophisticated investors such as family offices or high net worth individual, as well as institutional investors. In terms of the development of venture debt investment, you raised about what has been going on in Singapore. And let me be very frank here, Malaysia lags Singapore in this regard, but we possess a promising outlook. It's undeniable. Commitment of government is crucial in promoting the necessary market infrastructure that creates awareness as well as confidence of among players on the viability of venture debt. And the market potential for this asset class is huge, and it can be attained if we create an enabling environment. You have mentioned about the designs and the structure of venture debt. So from the demand side of the equation, venture debt has its share of challenges, and chief among them is startups and founders' understanding is very poor on the designs and benefits of venture debt to their optimal capital structure formations. From the supply standpoint, we have a problem in terms of understanding the attractiveness of venture debt. Venture debt is an alternative financing option, and it is a less risky instrument for institutional and sophisticated investors to gain exposure to and invest in some of fast-growing and scalable startups with proven product market fit and ready revenue base. So if I were to promote to institutional investors to invest in startup, I would say venture debt would be an easy selling point for them to have an exposure and potentially later on be converted into equity, right? So, and I've mentioned this before, lower yield environment and, sluggish public market, particularly in Malaysia, with fewer issuances, new issuances and fresh offering, that means the time is right to promote venture capital and venture debt instruments as a viable investment asset class. And the perceived riskiness of investment in startups can be reduced through co-investment, whereby institutional investors invest alongside one another in a venture debt funds or venture capital funds. So basically, what I'm trying to say here is that if institutional investors are fearful of this asset class, they can co-invest alongside each other through a fund structure, and fund structure that is managed commercially and also professionally. And here, that's why Penjana Capital seeks to actually catalyze the VC ecosystem so that we have more investment houses, we have more professional fund managers, and we have more VC and venture debt funds so that institutional investor can capitalize and leverage on.
in terms of venture debt as an alternative asset class versus venture capital fund, how can we attract investors to invest or subscribe into a venture debt fund versus venture capital, considering that venture debt usually provide a lower return profile?
I would say, venture debt, is an interesting asset class. Coming from someone in a public market, and we struggle to actually have a 10% annual return on equity, public equity. So certainly venture capital offer at least a minimum of 15% IRR annually. That is attractive proposition. But I think we talk about the lower cost of capital and the lower yield environment. We have looked at how the sovereign bonds in Malaysia MGS offer you 3%. And you look at investable credit market offering between 6 to 7%. So if you ask me, even the best startups could get 10% on its venture debt, right? Venture debt offered to highly stable startups with recurring revenue base would certainly fetch between 8 to 10%. So it gives you enough upside to your asset allocation to get that alpha. The thing is, we don't have a sizable market for these institutional investors to play with. So that's why we need to have more players to create more funds so that they can actually, we can actually mobilize this capital. Just to put things in perspective, our private pensions market is led by EPF, and EPF is fast approaching 1 trillion ringgit. And our sovereign wealth fund, 3 of them collectively, Khazanah, QOP, as well as Quant, actually represent more than 300 billion. Sovereign wealth fund plus EPF represent the size of Malaysian GDP. So that shows we need more opportunities. We need to enrich our opportunity sets. And this is where I think startups have a part to play, because startups is a viable entry point for them to get to that access to growth. We have we have a target, we set a target to have 5,000 startups in 10 years' time. We have a target of 5 unicorns within 10 years' time, and that is possible. And you mentioned about the attractive returns of the equity, which is at least 2 to 4 times multiple on invested capital, and that is doable in Malaysia. I give you a case in point, which is Qasem officially turned our first homegrown unicorn yesterday with a valuation of $1.3 billion. We started investing in Qasem 3 months ago in May. And our invested capital, our MOIC on our investment is 2.6 times. And the holding period is 3 months. So it is possible by having a convertible note. Try to close the bridging between the next fundraise. It's possible, especially for those startups with a business model, with a recurring business model, a revenue business model. So my point is, it is a viable asset class. It's just that we need to educate both sides, the demand and also the supply side. The supply side being the institutional investors, because the asset management industry in Malaysia is highly institutionalized.
Thanks, Taufiq. Thanks very much for those interesting views. With this, we'll end our second round, and we shall go into the third round, where we will be discussing on startup fundings and fundamentals. Okay, my first question will go to Cheah. Let us talk about funding bubble. How do you see the massive amount of capital in the industry impacting startup priorities and decision making by the investors?
I think based on our observation, we see 3 broad trends that came across to this so-called funding bubble. One thing is, of course, there's excess supply of funds out there given the amount of dry powder we see. Of course, then what it means earlier is, what I mentioned earlier is that we see more funding but fewer deals, and we've seen bigger rounds of ticket size. Average funds raised in Asia, we've seen an average growing from 40 million itself in 2010 to about 110 million in 2020. Deal size itself has grown up as well. If you see Series A itself grown from 6 million on average to about 15 million in between 2010 and 2020. So
This is ringgit, yeah, Cheah?
this is in USD.
USD.
So yeah, like I said, VCs are investing in fewer deals but with bigger ticket size each round. So startups, for you all to attract this attention of these big funds or these funds out there, I think they need to look beyond the market with 31 million population, and they need to go regional or global. So that's one. In terms of trends itself, I think Ben and Patrick has mentioned also earlier that I think more and more funds are actually now tech funds. So you got to, for startups, I think you got to embrace or adopt digitalizations in order to tap into these sources of capital for you to either stay afloat during this pandemic session or for you to grow further after moving forward. So this is in terms of investment trends. And the third thing is I think startups we've seen, like I said, started to have to incorporate more sustainability values in their business models. Asia's commitments to sustainable investing for PE itself, private capital as a whole, continue to grow from 2020 with a total AUM hitting about 210 billion US dollar compared to just 58 billion at the start of the decade. So social impact of COVID-19 pandemic has clearly intensified the industry's awareness on ESG, and also we've seen LP increasingly prominent in bringing forward the desire to invest in funds with social and environmental objectives. So this is something that startups priorities may need to consider if you want to attract these kind of fundings for them to move forward.
We see the emergence of new tech businesses in the last few years. And with the increase of dry powder or capital, more and more entrepreneurs chasing for capital. Touching on increased competition, there's obviously so much capital out there to deploy. What are you looking for in a startup these days? Are there things startups should be doing to win you over an investor that are any different in the past? Or is it still all about the fundamentals? Ben, can you give your thought on this?
So there's okay, I think I'll break it up into two. There's a kind of a quantitative part of it and a qualitative part of it, right? So in quantitative part of it, obviously we're going to look at traction, big one, however you measure it, be it MRR, revenue, GMV, and not just the absolute number, but the trend and the growth. Okay. So then after that, we're going to look at how the company manages its burn rates, or if it's burning money, and how we do, whether it is burning a large amount vis-a-vis the capital it has or a small amount, and then how it is managing, of course, those expenses, whether it is over or under hiring, and then after that, we also do look at the fundraise history, how much capital they raise, who the investors are, and how much the investors have invested, and what of course we think would be the probability of this company having to raise more capital. That's quantitative, and so we do a lot of calculations about how the projections go, how cash runway will look like, the ability of the company to flex up and down the cost structure so that they can increase or decrease burn to capture growth. So quantitative, I think the quantitative part is the easier part, to be honest. Qualitatively is very difficult actually. Qualitatively, first, it's an intersection of the market trends, the consumer or customer behavior, and the product right now, almost like a product market fit. So we need to see whether this company is, in a sense, moving with the market. For example, if now online is the rage, should be moving towards that. Whereas if you're doing something against the grain of the market, that will be a little bit different. So this is a very wide story that we have to assess. And then the last portion of it is to make a honest assessment about the founder in front of us. And it's the single most hardest thing to do. It's very hard to assess how the founder will react going forward, because we can only rely on third-party references or maybe resume or track record. Some founders have no track record. It doesn't mean that they're bad, but ultimately you need to make an honest assessment as to the founder in front. Does he have the does he have the will to make tough decisions? Because in a startup, there will be times that they make tough decisions to pivot. I think most of the successful startups or companies that we have seen through the last 5 years, I think all of them have gone through very stressful periods where the founder have stepped up to make the tough decisions that ultimately lead to the success, right, of the company. So you have to ask yourself these questions: whether this company is practical, and whether he has the guts to make such decisions. And lastly, for venture debt in particular, you also have to ask yourself whether the founder has a good enough understanding of what venture debt is, and whether he has worked out the appropriate value or use case for it and catered for its repayments. So these are some of the factors we look at. It's quite hard. I cannot claim to be 100% correct. Sometimes it's a bet, to be honest.
Thank you, Ben, giving us tip from lender's perspective. What about from borrower's point of view? If they were to approach lenders or funders, what would be your advice to them? How should they position the pitching to make it so attractive? Patrick, give us your advice.
Yeah, thanks, Farid. Yeah, I think for us, it's when we look at startup founders and we go for pitching with them, a couple of things that they really got to think of. One is they must be able to articulate value. Right? What kind of value creation that they are talking about here? Right? Bearing in mind, if their product or service or their tech, to a layman or to even a VC, it could seem common, right? And it could be in a very crowded space. So how do you demonstrate and articulate the value creation? How are you different? How are you unique from what are those in the market? Right? More often than not, a lot of entrepreneurs would want to think that they are the best, right? Without doing sufficient homework and research in terms of their competitors, right? How are they different? Then number two, they need to have a very clear focus in terms of the various milestones that they want to achieve over the next 1 to 2 years. So the investors want to look at, right, both from a venture capital as well as a venture debt perspective, is number one, what kind of returns can I get? So the more rounds of financing that you can raise at a higher valuation, it means better, right, from both a venture debt as well as a venture capital perspective. So from a venture debt perspective, it means that their money can get repaid, and with an option, right, with the warrants having an uptick in valuation as well. Thirdly, I would say it's the founders got to make sure that they are able to demonstrate that they have a coherent team, right? A team that can work together with different and complementary kind of skill sets, right? It cannot be too lopsided, right? Because in this day and age, even though you can have a good technology, but you are not able to productize it and monetize it properly, it's very difficult for you to scale, right? Last but not least, it's you got to demonstrate how you are planning to manage, right, the company, right, manage the finances, i.e. the profile of your fundraising life cycle, right? You need to be able to tell the investors or demonstrate to the investors that you thought about it. This is not a one-trick pony. This is not a one-time fundraise, and you're able to tell them, okay, you invest in me at this round, at this particular valuation. This is what I will do to achieve the next fundraising round at a higher valuation. And how are you going to do that? Right? And you've got to be realistic as well in terms of your assumptions. Be able to demonstrate that the assumptions are being well thought out and not something that you just pluck from the sky. Yeah, so these are kind of advice that I would typically give to the startups.
Thank you, Patrick. Very useful advice. I hope everyone here in the audience will listen to this, so you can adopt some of the key advice given by Patrick. It is a known fact that government plays a very important role in the establishment of conducive startup ecosystem, particularly in providing funding, facilitating support to bridge the funding gap faced by startup within the ecosystem. Can you please elaborate further on the importance of government role in startup funding in Malaysia? What has been done and what more can be done? Taufiq, as someone who is entrusted to lead one of the important government funding agency, can you give us some insight on this subject?
Thanks, Farid. You are right. Government of Malaysia has been playing an instrumental role within the space and for the industry. Regulators, namely securities commissions, has been tasked to facilitate the incorporation of VC companies as well as establishment of more new VC funds in Malaysia. Ministry of Finance has provided a number of tax incentives, which include tax exemption for VC companies and tax deduction for individuals or entities investing in VC funds domiciled in Malaysia. Government-backed agencies such as Malaysia Digital Economy Corporation, MDEC, Cradle, and Magic serve as ecosystem enablers and help commercialization as well as creation of startup pipelines in the country. And most VC financiers, like you said, in Malaysia are government-owned and funded. Government-backed institutions accounted for over 40% of Malaysia's VC investor pool in 2020 alone. So government believes that the development of innovation-led economy in Malaysia requires a vibrant and sustainable VC industry. And Penjana Capital's role through its Dana Penjana National Program is to strengthen the intermediaries as well as participation and support entrepreneurs as well as founders. Dana Penjana National, like I said earlier, is a matching fund-on-funds program where Penjana Capital as an LP will match on a one-to-one basis funds raised by VC fund managers, selected VC fund managers from foreign and local private investors. As an investment house, our approach in effecting these changes is the supply mechanism of patient capital and growth capital. Through our co-investment, especially with foreign investors, family offices, as well as local and foreign corporate VCs, we strive to improve access to this capital and improve capabilities of the intermediaries, namely VC fund managers. Through industry collaborations, government via Penjana Capital seeks to produce a holistic ecosystem and profile Malaysia as an attractive VC startup hub in Southeast Asia. In essence, government through Penjana Capital works to attract private capital, build capacity of local VC fund managers, and catalyze startup ecosystem by providing more availability of growth and patient capital to them. That's my answer, Farid.
Thanks, Taufiq. Cheah, this is a question for you. In one of the reports published by ICMR on venture debt, it was highlighted that to complement the VC industry, it is critical to ensure that debt financing is sufficiently available in the ecosystem and able to meet the different criteria across the entire VC value chain. Since this report was first published, has venture debt sector seen any positive development in the creation of more enabling environment for sector to grow, particularly in terms of regulatory framework and government-private partnership cooperation?
Well, that's a tricky question, but allow me to backtrack just a little bit about the venture debt report. It was a report that stemmed from a broader report that we conducted a research on the Malaysian VC industry back in 2018. So that VC report itself have identified like what Taufiq has mentioned also, what are the key roles that government has played over the last 10 years or so And then we looked into both equation in terms of the supply side, mainly the supply of financing, and also the demand side that is currently the status quo in the entire VC venture investing industry in Malaysia. So having said that, one of the key findings is that there's definitely a need to broaden the pool of investors and the GPs in the type of funds financing of options available in Malaysia, and also to deepen the amount of investments in Malaysia as well. So having said that, one of the recommendations is actually to broaden the types of financing and not just providing equity, but to provide debt financing in Malaysia, which is through venture debt, because we have seen how even these some venture capital funds are taking on subscription credit facility to actually provide lending to their investee company. So we see that this trend is growing, and then venture debt itself clearly has a very great potential in whether it's helping the LPs itself to gain extra to earn extra returns, and also for the industry itself, the startup and SME to actually have bridging facility or financing before they reach the next equity fundraising through another series. So having said that, we have also looked into some of the key jurisdictions in Asia, to be more precise in India, how they have actually grown their venture debt industry. It's a 12-year-old industry, if my memory serves me right, and it's growing very strong in India. They are most fund-specific VD funds providers are actually registered under the Alternative Investment Funds Tier 2 license. So with that in mind, in Malaysia itself, to actually grow the types of funding options in the industry, you need to provide a framework for people to come in, at least for GPs or practitioners to come in to provide such funds to the industry. Hence, we have suggested that to provide a proper venture debt framework for the registration of GPs in relation to venture debt to really help to actually spur the growth of this sector. So in that sense, I think the Securities Commission itself has looked into it and is currently in talks with some of the industry players to look into how this framework should be created. The other positive thing that we have observed is that, like Taufiq has mentioned, and thank God Penjana itself has actually diversified 16% of their portfolios into venture debt, which is, to us, it's a very good starting point, because before this we only have MDV alone in the market to actually provide VD financing. So I think it's a good starting point, and I think a lot more needs to be done in terms of education, awareness, and also creating, I think, repositories to ease due diligence, a centralized repository, whether it's for people who wants to know Malaysia more, because we have a lot of agencies and a lot of different tax incentives for different industries, and even for the VCs industry itself, for discovery purposes. It's also good for, like what Ben mentioned, it's for them to conduct due diligence, because quite often this startup industry itself is there's a lot of missing information or hard to get information unless you do a duty yourself on the owners, the founders, or the startup itself. So a national centralized repository would greatly help to enhance the growth of this sector. I mean, venture financing as a whole as well.
Very interesting, Cheah. Thank you so much. Okay, we are now in the final round of our discussion. In this round, we will discuss on talent and challenges faced by tech startups. Okay, it is not a secret that the startup sectors in general are riskier compared to traditional industries such as banking, auditing, consulting, or maybe general manufacturing. Hence, talent might be more drawn down to job stability than these type of companies are able to provide, especially the startup. In these regards, how much of this is an issue for IT startup companies in terms of having access to the right talent pool in the market? Is there still a talent crunch among the tech startup in Southeast Asia? I'd like Ben to address this subject.
Okay. Wow, big question. So, is there a talent crunch? I would say still yes. Is a startup attractive to work for? Actually, I think it's changing quite fast. It is actually. It's quite attractive to work for because the startup life, especially in the junior segments, is exciting. Allows you to build more things. So if you go to universities and chat today, right? There's a great portion of graduates or things that want to work for startups. So it's becoming quite popular almost. And then of course some of them want to start their own. So it actually is quite popular. And then there are some senior executives who are going to like later stage startups and all that. Consideration for the startup is what can the startup offer and at what stage to attract what type of talent. Sometimes the senior talent is very expensive. So those are some considerations. And sometimes the startup may look at offering equity so that the more senior people can partake in the story. But I think that is not the source of the talent crunch. I think the talent crunch is still in tech space, in the hardcore tech. For example, there is always a lack of coders, system specialists out there. I think that the supply of these people has increased, but the supply of companies that need them have increased faster. So there is no secret that the region has had to import a lot of tech talent, sometimes from India, sometimes from Vietnam. And so now COVID made that harder, right? So you can't really import them, but they still exist. So you start to work remotely. And then that leads to some trend of sometimes you may hear of development houses, outsourced development houses that do this. But for me, I think the talent crunch is in tech, specialized tech guys. Everything is online, but there's only these few number of experienced coders and programmers.
Thanks, Ben. Patrick, what's your view on this?
Yeah, I think I echo what Ben just said, right? I think if you look at the psyche of people in Asia in general, we've been brought up, going to the banks, going to asset management companies, big corporates for that matter, right? But the situation is changing rapidly, right? I think it boils down to what kind of message we want to put on the ground. What kind of education are we giving to the younger ones? And back to, again, Ben's point, in fact, it's getting a lot more attractive to work for startups. In fact, I lost a bunch of folks in the last couple of weeks just to startups, right? In different roles, financial role, operating roles, and so on and so forth, right? So is there a tech crunch? I would say yes, right, in different aspects. Of course, it's well publicized that we have a shortage of tech coding people, programmers, right? And it doesn't help the fact that being tech in the tech sector, it is cross-border. And what this means is that we're all fighting for the same talent. Someone in Malaysia can coach someone in Indonesia and vice versa, right? So the war for talent is just not going to be relaxed. It's just going to heat up, right, accordingly. And with this pandemic, border closure, you can't import talent as easily as in the past, right? No matter where they are seated, right? But to a large extent, there is some form of mismatch between what the tech company needs and what is out there in terms of the talent that's actually available, right? But to summarize it, there are good talent both in the financial, operational aspects that's willing, right, to switch from traditional companies to go into a startup ecosystem. However, right, from a tech coding perspective, that is a more pervasive and a more macro problem for all of us.
Thanks again, Patrick. Okay, my next question will be for Taufiq. When we talk about startups, I think it is hard to avoid the topic on unicorn and decacorn. In the US, of course, has the most unicorns as of today. But in Southeast Asia as a whole, bringing up a lot of unicorn as well. In fact, Southeast Asia alone, we have Indonesia, Singapore, and the Philippines that has successfully grown this so-called unicorn and decacorn. For Malaysia case, the government has set an ambitious target to attract or grow at least 5 unicorn by 2030. From your observation, is this an achievable target? And what can Malaysia do in order to achieve this target? Or what Malaysia can do perhaps differently in order to realize this? Can you also briefly describe what a unicorn and decacorn for our audience who might not be familiar with the system?
Sure. So let me start with the definition as you suggested. A unicorn is a privately held startup that hits $1 billion valuation or more, while a decacorn refers to a startup company that has a current valuation of 10 billion or more. And now we have hectacorn, which is a technology company valued over $100 billion. You know, I was just reading Financial Times recently, 4 of the hectacorns in the US, Apple, Amazon, Facebook, and Alphabet, actually in terms of a combined market valuation is greater than the whole 2,100 Japanese companies listed on the main board. So just to show you the size that this unicorn can actually grow into. To answer your question, my prejudicial view for someone who's actually in the industry is that the target to grow and attract 5 unicorns for Malaysia within the 10-year time frame is certainly achievable for various reasons. First, Southeast Asia offers deep and rich investment universe of promising startups, and specifically for Malaysia, the opportunity set is increasing. Southeast Asia has over 600 million population with growing infrastructure and rising technology adoption, offering attractive, addressable, as well as obtainable market for new innovation, products, and business model. And Malaysia sits in the heart of it. In terms of infrastructure, we are leading the pack, perhaps slightly behind Singapore, but given the ratio to size, we perhaps leading the space. Second, the region is home to some, of cash-rich institutional funds, low-geared corporates with strong cash buffer, mostly hungry for regionalization and acquisition, and sizable middle class with rising savings. So even though VC industry in Malaysia is less mature, the country's asset management industry is highly institutionalized with ample liquidity to be deployed. Therefore, there is a growing potential. There is a potential for growing availability of savings and capital to be mobilized for innovative products, for fast-growing business model, and for scalable startups. Recent successful IPOs of unicorns in the region bring attention of global funds to Southeast Asia, as well as Malaysia indirectly. And this region is fast becoming an attractive and investable asset class. So for me, given that success breeds more success, I believe that it is possible to achieve 5 unicorns for Malaysia in the next few years.
It is interesting, Taufiq. Just to add on this, you mentioned that Southeast Asia, with a population of 600 million, based on this alone, it presents a huge opportunity for companies to grow and expand into the whole entire region. But I can see there are challenges that as well, especially in the legislation and regulation. Southeast Asia consists of a total 11 countries, and each country has different regulation in terms of doing business. What is your view on this, Taufiq?
Farid, traditional wisdom says that conflicts are born out of differences. To me, innovation comes out of heterogeneity, not homogeneity. And the fact that we have a different level of jurisdictions and readiness, regulatory readiness, means there are opportunities for pain problems to be solved by these startups. So there will be more creativity, more innovative solutions expected out of these promising young founders and entrepreneurs. To me, this is a selling point. Take a case in point, Europe is also not exactly a common, homogeneous market, and yet they actually become now a center of gravity for startups creations. And also the VC industry is fast growing, mirroring the growth of early stage of VC industry in Silicon Valley. So I think we have a part to play, and there is a huge potential for market here in Southeast Asia. I just want to give you also another point to consider. We're talking about growing infrastructure. The governments are supporting the digital infrastructure. We are at that inflection point. We are at that technological and adoption inflection point. We have yet to grow the regulatory space. So in terms of regulation and jurisdiction, it is a sandbox. It is up for a game. It is not mature enough for us to dictate and create a barriers to entry for these startups. So I think there is a room to grow here. So to answer your point, slightly I disagree with you. I think this is an asset for Southeast Asia.
Thank you, Taufiq. Patrick, I'm going to move on this, to you. You're dealing with many businesses, SMEs especially. You probably the best person to answer this question. What do you see as the biggest obstacle that could prevent a promising startup from scaling up? What are among the X factor needed by startup to be able to make it in the market?
Yeah, thanks, Farid. I think some of the use cases that we have seen so far would be the failure to plan ahead, right? Because some of the startups, they are chasing for the explosive growth. But with explosive growth, you need proper planning, you need financial resources, you need human resources as well, right? If not, that growth at some point will not materialize. Right? So that's one of the biggest obstacles that we have seen. The other part is, I think I touched on it earlier, that the founding team, the management team, they need to expand and bring in the right skill set. Because the initial founders, with the kind of skill sets they have brought the company up to a certain level, but they need a different kind of skill set, or they need different mentality to bring people on board, right, to drive the business further and achieve the kind of explosive growth that they're expecting. So I think these are the two key points that I just want to make on this particular topic.
Thanks, Patrick. Ben, given your immense experience in watching startup pitching, for their business idea to you, what do you see as the most common mistake or pitfalls as they try to raise capital? What are the common pitching mistakes that founders make during capital raising round?
Yeah. Okay. I know that there are a lot of common mistakes that stem from too long, no detail. That I like to offer you my perspective. Typically, we look at maybe almost one company a day, for the last few years. Actually, I think the most common mistake stems from one thing. In an initial pitch, I think a lot of founders may not get the purpose of the initial pitch, the goal of the initial pitch. So from my perspective, the initial pitch that a founder makes, his goal is not to deliver the passion or show whatever. That's true, but that's not the goal. The goal is actually to get the next meeting. That's all it is. Because think about it in practical terms, if for investors who are looking at a few hundred of companies a month, you need to stand out and get the next meeting. The initial pitch should be short, and I'll say it again, the only objective is to get the next longer meeting where you can share your passion. If it is too long-winded and you've lost the investor, you've lost it. You can't have the next meeting. So I think too little founders pitch with that mindset. every time the founder show up, he's about to give you this 20-30 page presentation and tell you his life's work. It isn't going to work for a first pitch. All you need to do is grab the investor's attention and get the next meeting so you can share your life's work. I think that's one thing which I think a lot of founders they don't get. So you expect to see short, sharp, concise pitches that grab attention and get the next meeting. That's it. I've said it. I think that's it. The rest of it about like the things too detailed, maybe what should you share, doesn't matter. Just research on who you're talking to, stand out, and schedule the next meeting.
Thanks, Ben. All right, gentlemen, we are reaching the end of our session. I have one final question to all our panelists before we let them go. The question is, where do you see the venture debt space in Malaysia in the next 5 years? Will it present more opportunities or create bigger risk? How will you be able to mitigate those risks? We shall start this with Taufiq first.
I will start with a pessimistic note, given my experience in a public market and a private debt market. In the case of Malaysia, even A-rated space, corporate bonds, are not well taken up. And the reason why there's no liquidity, no volume, no breadth, no depth in that segment is because lack of participation of institutional investors, local institutional investors. Barring this and understanding the common pitfall here, it is very imperative and very important for the government to actually spur this market, i.e. venture debt, by having more participation from local institutional investors. And that problem can be solved through co-investment.
Thanks, Taufiq. Cheah, what's your thought on this?
I personally think that, of course, there's a lot of room for this industry to grow, for venture debt in Southeast Asia and Malaysia, because we are just at our starting point. I agree with Taufiq, what he said earlier, that more work needs to be done in terms of bringing in more players, and also in terms of creating awareness and education. I think that's the biggest obstacles here. We have no shortage of funds in this part of the world. It's just how it's being deployed currently. Some are through, like I said, subscription credit facility, and all through the venture capital and private equity manager, existing manager. It's just that what you need to do is to bring in a more specialized pool of VD practitioners or GPs in this space, and not just bringing them in, but providing a safe framework or environment for these GPs to actually operate is utmost important. And the other thing is also equally important is creating awareness and education for both the LPs, the investors, the GPs itself, whether the first-time GPs who wants to embark on this journey, and also even for the startups or the founders itself on, the benefits, and then what actually what do you get out from VD itself as a financing options for yourself.
Thanks, Cheah. Ben, any thought on this?
First of all, I see venture debt market intertwined with the venture capital market. I mean, it's almost like a percentage or subset of the venture capital market. And I see in Southeast Asia, and I'm sure Malaysia included, the venture capital market is growing. If you talk to a lot of institutional investors out there, they have been keeping tabs on this region for some time now. But now they start to be a bit more serious, to come down. Few reasons for it include the increased number of unicorns being minted out here, and not only that, the increased optimism about the unicorns being able to exit, inverted commas, i.e. go for IPO, acquisitions, all that. This is going to attract a lot of the overseas VC money here. So that's the pull factor. I guess the push factor is the largest VC guys are from Silicon Valley and China. We have offices in China, so we have a first-hand view of this. There, the VC market is very competitive. We returns are being pushed down on that. So but there's a lot of mega funds, and the mega funds need a way to find the next frontier, if you will. So Southeast Asia, to them at least, is one such area that they must come. And these guys are having funds in the billions of dollars, no different than Silicon Valley. So they're coming here en masse. This is gonna spur the growth of the VC market. With the growth of the VC market, as how we saw in US history, there'll be the emergence of venture debt guys, because when we lend to companies, we now have a little bit more assurance that these companies will be able to raise. There is no, I think maybe 3-4 years ago, people talk about a Series B crunch. Not enough people funding a Series B. So if you're venture debt lending at Series A, be worried about whether your company can raise Series B. No crunch now, I think. Now Series B, no problem. So as you have less of this kind of funding crunch at the stages, it's ripe for earlier stage lenders like venture debt, and maybe I would argue even earlier stage investors to come in. So I'm overall quite optimistic. I think no country in the region can ignore this. All countries will have to take advantage of this kind of momentum one way or another.
Interesting. Thanks, Ben. And finally, Patrick, what's your view?
Yeah, thanks for that. So if you look at the evolution of the VC and venture debt industry, historically in the established markets like the US and Europe, they typically take up to between 10 to 15% of the overall venture market, right? Venture fundraising, right? And if you look at India, it's around 8%, right? Then you bring it closer to home to Southeast Asia. Based on the research that we have done, FY21 is highly likely, if we follow the current trajectory, right, we are likely to hit a record year for fundraising in FY21. And what this means is that for venture debt growth, right, we are estimating probably between 0.5 billion to a billion, right, across Southeast Asia. And that's a good growth, right? And even for us, currently it stands only 2 to 4%. So what this means is that there's huge room for growth. And it's a case of maturity. As the market mature, eventually when you can't get a kind of a returns, right, from the public markets, you can't, there's competition for venture capital into equity deals. The next area to look at eventually, due to maturity as well, it will be venture debt. So I am optimistic, in general, all right, about the growth of the BD market here in Southeast Asia. And if you look at the Malaysian market, right, it's a big market, right? It's a very vibrant and dynamic market where there is a huge number of startups. So the key, like what Taufiq mentioned, is to bring in the institutional 10% returns in the VD space, as opposed to traditional mutual funds, the VC space, right? So I think all these factors, all these variables will play a part in the growth, of the venture debt market in Southeast Asia.
Great, thanks, Patrick. Okay, ladies and gentlemen, we have come to the end of our session. I personally find our distinguished panelists' viewpoint are very insightful, useful, and of course, so many useful tips which we could leverage on, especially both business owners to both business owners and also funders. In particular, the subject matter of venture debt as an alternative funding option for business owner. While this is an alternative asset class for investors to choose from as well. To end this session, we'd like to wish all our audience the best and stay safe. Thank you.
We have another session, more content, inspirational, informative, and very, very useful. Don't go away. Join us in the next 5 minutes. Dubai Expo 2020.